My name is Alex Swansson. I'm Head of Superannuation at Partners Wealth Group. Today I'm going to talk about self-managed super funds, your path to financial freedom. So what is a self-managed super fund? Well, a self-managed super fund, or SMSF, is a private superannuation fund that's regulated by the ATO. The members of the fund are responsible for all the running of the SMSF and are also responsible for complying with superannuation laws. Key features include there must be no more than 6 members. All members must be trustees or directors of the trustee company. The members decide how to invest their superannuation savings. Accounts of the fund need to be prepared, audited, and lodged with the ATO annually. SMSFs are complex to account for, so you will need the assistance of your accountant to operate efficiently. So at 30 June 2023, there was $876 billion of assets in self-managed super funds, which equates to about 25% of all superannuation assets. There's 606,000 funds consisting of 1.136 million members. That's about 5% of the adult working population of Australia. Top assets held in SMSFs include listed shares, 29%, cash and term deposits, 15%. And interesting enough, 87% of SMSF members are 45 years or older. So they're people with larger superannuation balances that have got a longer working career. So what does an SMSF look like? Well, 24% have 1 member, 68.7% have 2 members, usually husband and wife, and less than 7% have 3 members or more. The average assets per SMSF at 30 June 21 was $1.472 million, with the average assets per member $790,000. Here's some of the key benefits of an SMSF. They include investment control, power of flexibility, strength in numbers, secure your legacy, and effective tax management. So unlike retail or industry funds, your investment choices are less restricted in an SMSF. In addition to investing in shares or fixed interest or managed funds, SMSFs can also invest in direct property, both residential and commercial, with or without borrowings. You can also diversify to hold physical gold or other commodities, and even collectibles like art. SMSFs can invest in single managed accounts, which allows for better tax planning at retirement. There's also a growing trend for investing in cryptocurrencies, an investment class that is not available to industry fund members. Power of flexibility. You determine when to buy and when to sell your investments. You can obtain an insurance policy customised to each member. When you're in retirement phase, you can easily withdraw funds without lengthy waiting times, as you control the fund's bank account. You can align your investments with your financial goals, maybe having more growth assets at younger points in life and more defensive stocks after retirement. It's interesting to note that millennials will be the first generation to receive superannuation guarantee contributions for their entire working life. And they're wanting more increased control of their superannuation. And they're looking at SMSFs for that flexibility and control. Strength in numbers. SMSFs can have up to 6 members. You can pool your resources to purchase assets out of the reach of an individual investor. By combining funds, you can access lucrative investments such as property or wholesale alternative assets. Small business owners may consider owning their commercial property in their super fund and leasing it back to their business, thus guarantee them security of tenure from their landlord. And when you have got illiquid funds, you may want to consider contributions from younger members to aid cash flow. Secure your legacy. Superannuation does not form part of your estate, and it's governed by the trustees and superannuation laws. And a key advantage of an SMSF is to develop a comprehensive estate planning strategy. SMSFs allow for non-lapsing binding death nominations and reversionary pensions. In industry and retail funds, you need a BDBN updated every 3 years, which can be annoying and frustrating, and it's easy to miss. Assets such as property can be passed down through generations. You can even transfer property in a super fund to yourself at retirement. You can choose how a death benefit is paid and which assets are required to be sold to pay any lump sum benefit. And processing death benefits in an SMSF is less complex than industry funds, who may require death certificates and probate and approval from a benefits committee. Effective tax management. SMSFs allow you to manage buying and selling decisions relating to your investments. You can carry forward any capital losses. In industry retail funds, they're blended with other members. Or investment income to support pension is tax-free once members are in pension phase. So capital gains can be reduced to nil if realised after a member has commenced retirement phase. So for assets like property, this could be a significant saving. Say, for instance, you bought a property 5-10 years ago for $500,000 and sell it today for $1.5 million. That $1 million, so long as every member of that super fund is in pension phase at the time of selling, that $1 million of capital gains will be tax-free. There's also another good benefit, which is the future liability deduction, which not everyone is aware of, but Section 295 of 470 of the Income Tax Act of 97 allows an SMSF to claim a deduction based on the fund's future liability to pay benefits. So this deduction is available on the payment of a death benefit, terminal illness benefit, disability superannuation benefit, or temporary incapacity pension. I've got a worked example so we can go through what the power of this deduction. Harry is 48. He's married to Megan, who's been a member of the fund since 30 June 97. Harry's date of birth is 1st of July 74. He owns a $1 million life insurance policy. Harry died on the 1st of July 23 with an accumulation balance of $500,000. Megan will receive a death benefit pension, a lump sum of $1.5 million during FY24. And the formula to calculate the future liability deduction is benefit amount times the future service days divided by total service days. In this case, 1.5 million times 5,873 divided by 15,342, or $573,000. This $573,162 can be used to offset the fund's assessable income going forward. If the fund was earning, say, $70,000 income a year, the fund would not have to pay income tax for the next 8 years. Now, the benefits can only be used for people in accumulation phase. If there are no longer any members in accumulation phase, you may want to introduce your children, such as Archie and Lilibet, and they can get the benefit of the tax deduction in the future against any future income. I'd like to finish with busting some 5 common myths about superannuation, or SMSFs. 1, SMSFs are for over 60s. Well, that's not true. In the last 12 months, 61% of new funds had members less than 50 years of age. You need a balance of at least $200,000. Well, there are low-cost operators and low investment options that are equivalent to industry funds at $200,000, but given the types of investments and what we see that $300,000 or $400,000 might be a better starting point. SMSFs are complicated to set up and manage. That's not true. Most setups take less than a week. In fact, it's setting up the bank account takes longer than setting up the super fund. SMSFs are inherently risky. Well, this is not true. The risk is dependent on the investment decisions. If funds are invested in shares and cash like industry funds, they'll have the same risk profile, but obviously if they invest in more risky investments such as cryptocurrency, then they might have more volatile gains and potentially losses of capital. And lastly, SMSFs are cost prohibitive to set up. Well, this is not true. In fact, this month, Partners Wealth Group have got a current promotion of $1,400 setup cost, and that's including a new trustee company. So if you think you're going to have your supplementary super fund for, say, 30 or 40 years, $1,400 amortized over 40 years is not a large cost at all. I'd like to thank you for your time, and if you'd like to reach out, please contact me at aswanson@pwg.com.au. Thank you very much for your time.